So, hello everyone. Thank you very much indeed for joining us today. I am delighted that we have such a good representation of people joining us, particularly from the US, and we have a fairly large number of fund managers in the US with us here this afternoon. My name is Simon Osborne. I am the CEO of IFI Global, which is an asset management research and media house based in London. But we do a lot in the US, where most of the people following us today are based. In fact, I think it was our very last pre-pandemic event, last physical event was in New York in the early part of last year, and it was on ESG. So in a sense, it's nice to be coming back on the same subject to a predominantly US audience. And we hope very much that we will be back in New York in person later in this year. IFI Global has 3 monthly publications, and one of these specializes in the impact of ESG on the asset management industry, particularly how the structure of the industry globally in the US, in Europe and elsewhere, how it's going to change as a result of the ESG revolution or evolution. Our aim is very much to grow that publication in the US this year and next. So this is a subject that we will be coming back to many times in the foreseeable future. Joining me on the panel today, we have Deborah Francis, who's a partner at Seaward and Kissel, as I'm sure many of you know, is a major law firm in New York. Andrew Mitchell, CEO and founder of Equilibrium Futures, who's based in Jersey. Elliot Revson, who's head of funds at Jersey Finance. And Bob Swarup, who's principal at Camdor Global Advisors in London. I'm going to ask them all to make some brief opening comments in a few minutes, but I'm going to start with a few slides, really just to set the scene of what we're going to be talking about. However, before doing that, I would like to thank Jersey Finance very much indeed for sponsoring this event today, and also to mention that we have just launched a report on fund domiciliation with Jersey Finance. It includes a section on the impact of ESG on fund domiciliation patterns. And I think I'm right in saying that is the first time research has ever touched upon that subject. And we would, of course, be delighted to share that with you all. Today, we are going to look at the impact of the Biden administration on the development of ESG, both in the US and worldwide. And we are also going to ask if it still makes sense for the E and the S and the G to be grouped together in the way that they have been up until now. I thought I would start by making the point, which sometimes is lost on occasions, by stating that ESG really is more than an investment strategy. And why do I start with that? And that is because I see recently there have been a lot of comparisons made to other thematic investing crazes, bandwagons, whatever you want to call it. The 2 big ones of my lifetime were the emerging markets boom, and then about a decade later, the tech bubble. And there have been some people saying, well, this is another thing like that that's come along. We don't think so. We think it's fundamentally something that's very different, but doubtless it's also, in many respects, particularly now we have ETFs, so many ETFs jumping on the ESG bandwagon, it's clearly got its frothy side too. But with institutions supporting the UN's PRI, as I'm sure you all know, PRI stands for Principles for Responsible Investing. The institutions alone, let alone the other forms of investors, have assets of over 70 trillion. They really started this thing. They really are still in many ways driving this thing, although many other entities and investing categories have come to the party too. They are not short-term investors. They are in this for the long term. And simply another reason why it's different from other investing trends of my lifetime is the sheer size of this thing. I put up on the screen a forecast by Bloomberg Intelligence, who suggests a very specific number. I don't know why they came up with such a specific number, but by the year 2025, ESG assets worldwide will reach the figure of $53 trillion. I guess it all depends on how you count it. There's lots of debates on that. But even if you take the narrowest and most modest way of counting ESG development, assets today, I think everyone would agree, are over $30 trillion, and by any measurement are moving up very quickly. So simply the sheer size of this thing is something I don't think any of us have seen in our lifetime before. And I very much like this quote from the author. There were several people at PwC who worked on this report. It was a big report PwC globally published on ESG. I think it was at the end of last year. The lead author on that came up with this comment that ESG, he thinks, is a once in a century opportunity. But ESG, and this is what our publication, the briefing report, really focuses on, is going to, in our view, very much impact the way the fund industry globally operates. I'm not going to mention investment strategies, processes and goals, but that's exceedingly obvious. We all know that. I would quickly like to touch upon the industry, particularly outside the US, its peripatetic structure. In Europe, for example, and elsewhere around the world, typically you have a fund manager in one place, an administrator in another place, a custodian somewhere else. You have service providers in various other places too, and they may well have a back office in India or the Philippines. You have investors all over the world. The fund directors are all over the world, and as are the distributors. It's an incredibly peripatetic industry with an enormous carbon footprint. And I wonder whether or not that might change in some respects in the coming years. And I think it will have a really huge impact upon the governance arrangements of this industry as well. We have another publication called the NED, which specializes in fund governance. One of our researchers has been recently going through in a lot of detail the SEC's Form ADV, and she's taken the board composition of 75 of the largest global fund managers, and taking just the data from the SEC's Form ADV, we have discovered that 41% of those fund managers, or those asset managers on their funds, 41% have no women on their board at all. And I think gender diversity is a proxy for all other diversity too. If they're not diverse in terms of gender diversity, I very much doubt that they're diverse in any other way either. But I very strongly expect that is going to change, and it probably already is changing very quickly indeed. So the US comes to the party, and that's going to be a big focus of what we're going to be talking about in a second. It's perhaps worth making the point in passing that, at least as far as I'm aware, this is the first time in my professional life an investing trend has really been developed elsewhere in the world and has come to the US. Everything else, whether it be mutual funds, alternative funds of different shapes and sizes, hedge funds, private equity, whatever, ETFs, you name it, everything is really normally created and started in the US, and we in the rest of the world copy what the US starts. ESG, it's not, it's the other way around. It really started particularly with the North European pension funds that are wanting to invest in the things that they wanted to invest in. Australia is very strong on it, Canada, etc. And we are where we are today. So the US is coming to the party. According to the SIF Foundation, this is even during the previous Trump administration, there was tremendous growth, 42% increase in ESG assets in the last 2 years, up to just over $17 trillion, according to the SIF Foundation. And the Biden administration now obviously in power is removing the obstacles that were there when Trump was in power, such as putting limits on how much pension funds can invest in ESG assets. And this new administration has some very ambitious goals to have a carbon neutral power industry across the US by 2035, which is not as far away as you might think. And then the entire country going carbon neutral by 2050. And we are perhaps, and I hope this is the case, the situation where the US has been a global laggard, but it may be very quickly going from global laggard to leader. And I think this quote from Winston Churchill is relevant in the situation. Americans will always do the right thing after they have tried everything else. So that, one other slide, and then we'll go on to the panel. One of the other things we're going to talk about today is what ESG actually really is. You can say it dates back, if you want to the Quakers in the 1800s, who really started socially responsible investing, but more immediately and specifically, the term was started by Kofi Annan when he was UN Secretary General in the year 2005. The UN launched its PRI in 2006. And one of the things that I'm increasingly interested in is why we have today, after this astonishing growth over such a relatively short period of time in human history, still clubbed all these different things together. And the environmental thing is different. We're going to be talking about nature as well in a few minutes. Environmental, social, and governance all clubbed together in the way that they are, with assets well over $30 trillion. Does it make sense to have much better categorization going forward? So that is enough from me for the time being. I'm now going to stop sharing screen. Hopefully the panel will come up, and they have. I'm going to ask each of them to make introductory comments, and then we're going to get into the Q&A. You are all very much encouraged and welcome to join in. Just use the Q&A button at the bottom of the page if you'd like to do that. Don't wait for questions at the end. We hopefully will have a few minutes of questions at the end, but don't necessarily wait for that to happen. But let's quickly go around the panel and ask them for their opening comments. Debbie, can I come to you first? Where do you think we are and what's going on from your perspective in New York?
Sure. Yeah. Thanks, Simon, for having me today, and thanks to everyone for joining. So, I mean, I think obviously Simon, already kind of previewed this in his remarks. I think the U.S. has been, late to this. I think we've seen obviously a lot of the innovation in other countries throughout the globe, particularly, Europe has been a leader with the SFDR disclosures that recently went into effect. I do think, kind of both with the new administration and also just, I think, the U.S. pension funds and endowments and foundations making this more of a priority. I think we're going to see, and we have seen, continued interest by regulators in the case of disclosure for fund managers. And then also just on the investor side, I think the due diligence process, both in kind of the specificity that they're looking for from fund managers has increased dramatically, I would say, really in the past 2 to 3 years, whether that's in side letter requests or kind of RFPs or due diligence questionnaires that they're making managers complete. And we've, heard from a number of large allocators in the U.S. where they really are now developing kind of a scoring system for their managers, and they're including ESG and how the manager addresses ESG issues, both in its investment process and then also within the firm, which kind of goes to the diversity point that you mentioned earlier, in those kind of scoring matrix. And so obviously, if that's a situation where you're looking to engage with these allocators in order to gather assets from them, you really need to be making sure that you're taking these things seriously. That kind of, I think, gone are the days where U.S. managers can get away with a more kind of aspirational, ESG policy that basically just said, nothing more than the fact that we are aware of these types of principles and we look to consider them, kind of where appropriate in our investment process without any further detail. I think, both from a regulatory perspective, that's not going to be sufficient. And then obviously from an investor perspective as well. And so, I'll focus a little bit later on kind of some of the initiatives the SEC has taken. But I think there's, been a lot of things that the Biden administration has done. I think there's a virtual summit on climate that, the U.S. is going to be hosting later this month. I think in advance of that, they're going to announce kind of the 2030 emissions targets for the U.S. There's also kind of in relation to more of the S part of it, as opposed to just climate and environment, there's been a creation of a formal House Office of Diversity and Inclusion and Senate Democratic Diversity Initiative as well. That's going to track not only the diversity of kind of the staff and the House and Senate members, but also kind of the diversity of hearing witnesses. So I do think there's kind of a number of new initiatives that we'll be seeing in the next couple months.
Thank you. Elliot, can I come to you next for some opening comments?
Sure. Good afternoon, Simon. For those of you who don't know me, I head up the fund sector at Jersey Finance, which is the industry body for the finance industry in Jersey. And so predictably, I'm going to come at this issue from a jurisdictional perspective. I spend quite a lot of time looking at trends in the alternative space, and I think it will be interesting to frame ESG in that context. I think that the global investment trends that have dominated over recent years will continue in the years to come. In a nutshell, we will continue to see strong allocations by investors to alternatives, and there is no sign of investor appetite slowing down, and private equity will remain the main beneficiary. Inevitably, this wall of capital will create challenges in finding quality investments to deliver sustainable returns, and that competition for top-tier assets will lead to pressure on valuations and prices. We will continue to see regulatory and investor pressure on alternatives to build transparency and trust in all aspects of their operations. But within this, the one area where this pressure has accelerated over the past year is in the ESG space. And it's been very clearly driven by investors, and managers are responding. In the recent survey Simon mentioned, and that we commissioned from him and IFI, all of the investors surveyed, as well as 61% of managers and advisors, noticed that ESG criteria will play an increasing role in fund domiciliation, and indeed in the selection of service providers, which is also interesting. Of the balance of those interviewed who did not agree, the overwhelming majority came from the US. And what this gives us is a very clear and accelerating trend emanating from Europe and Asia towards ESG. I personally believe that over time we will see the US managers who want to access those markets will have to comply with investor requirements, and arguably this has begun. Similarly, the issue has not yet fully filtered through to the jurisdictional level, but given the trajectory, we can expect this to be the next step. We have started to see this in Europe with the implementation of SFDR, as Debbie mentioned, but albeit that was in a watered down version to what was originally planned. Within the report we commissioned from Simon and IFI, we saw that only 12% of interviewees believed that it would be beneficial for an agreed international standard of regulation for ESG. And that's fine, but as we have seen in other areas of regulation, this gives rise to the potential for regulatory arbitrage. But I think that this potential arbitrage misses the point here, and that is that the drive to ESG is being driven by investors, and in particular next generation investors, and it's a very genuine and very real requirement. And as we've seen with other areas such as trust and transparency or stability and governance, those investors will demand jurisdictions that pragmatically and robustly meet their requirements. And given the Deutsche Bank report and their expectations that ESG assets are likely to increase exponentially to surpass $100 trillion by 2028, which is actually far more bullish than Simon's Bloomberg figure, there's a very significant business case for jurisdictions to do so. And I think that this is a context within which ESG needs to be addressed from a jurisdictional perspective.
Thank you very much. Lots of stuff there, and doubtless be coming back to that a little bit later. Bob, can I come to you?
Sure, and pleasure to be here, Simon. So for those of you who don't know me, my name's Bob Swarup. I run a company called Camdo Global Advisors. And we do, from an ESG perspective, a lot of work on ESG, looking at both kind of areas such as frameworks, but also going all the way down to thinking about ESG metrics, creating ESG products, funds, and things like that. My own background is really a mix of alternatives, pensions, insurance. And so I come at it from really two perspectives. One is substance as opposed to style. And the second is the institutional side. Because one of the other hats I wear is that I run the CIO network for an organization called the Geneva Association, which represents approximately about 85 of the world's largest insurers and reinsurers. And that includes a number of large US firms, for example, AIG, MetLife, State Farm, and areas like that, in Europe, in Asia, and so on. And you get to see a lot of what institutions are doing, And you also get to see from the other side a lot of what people are trying to do to meet this demand. So let's take a step back. When you look at where the US is right now, probably the big surprise, I think, for a lot of people post the last election has been that actually Joe Biden, rather than being a centrist, has moved very rapidly forward on a far more progressive stance. And I suspect behind that, there's also this worry at the moment, which you see expressed a lot in the media and amongst briefings, that come the midterms, the Democrats may actually lose the House of Representatives. And so as a result, there is this move to try and get as much as they can done in the next 2 years. So you expect change. But I think, as you know, the other participants have already pointed out, this is also being driven by investors. I mean, there's an accelerant here right now, which is government, kind of policy, but there's also investor demand that is really pushing this forward. And that is because they are coming under increasing amounts of stakeholder pressure themselves. Bear in mind that pension funds, for example, have their members who increasingly are agitating significantly about what is happening. When you look at university endowments, similar from both the faculty as well as the student bodies. When you look at regulators, they're starting to worry about this as well. And they're all coming under pressure. And this is the result of that. And in a sense, that just gets passed down the chain ultimately to asset managers, to service providers, and so on and so forth. And that's something that we're going to have to try and get adjusted to. Now, people have thrown some big numbers around, like $75 trillion, $100 trillion. Let's put that in context, okay? Globally right now, the total quantum of public fixed income assets is 100 trillion. The quantum of stock market assets, so equity assets, give or take the last few months, is somewhere around 80 trillion. Get down to, say, for example, hedge funds or private equity, you're down to 3 trillion. When you talk about 75 to 100 trillion of assets being ESG, what you're really saying is that this is not a strategy anymore. This is effectively an overlay that will go across the investment process, the selection process, the risk management process, the regulatory process for a whole swathe of the world's markets. So anybody who plays in that, whether they actually have an ESG policy or an ESG approach or not, is going to find it's going to appear in many, many different ways. It's going to become part of the way they interface with their brokers, the way they deal with service providers, what investors will ask them for in their DD, and so on and so forth. And that is going to be the big challenge, because if I have to isolate one problem that exists in the industry right now, and it exists, by the way, across everyone, even the regulators don't know about this, is that nobody knows what the hell ESG actually means. I mean, we live in a world of acronyms, and it's yet another 3 letters someone has chucked at us. And the issue is everyone talks about ESG. No one's actually defined it. And importantly, no one's realized that ESG is pretty specific to who you are. Some people will define it as E, which is climate change, 1.5 degree world and all the rest of it. Others will think more about S, which is diversity, inequality, social, dimensions. And of course, the G, it does be very silent because that's like the governance in the background. And so I think if I can just, pause there in a second, Simon, what I really want to say to people is that what is happening right now is a lot of change. We can react to it in a very reactive way and panic and do lots of stuff and throw our hands up in the air, or we can try and understand what it really means for us and think about how we take it forward into a way that is not a quick flash in the pan, but actually accretive and substantially a path that drives the business forward in a changed market environment.
Okay, thank you very much. Again, an awful lot of stuff there we'll try and come back to. And Andrew, can I come to you?
Yeah, hi, my name's Andrew Mitchell. I'm based in Jersey and I have a firm here called Equilibrium Futures. And we advise the finance sector on environmental risk and help Jersey produce a strategy for sustainable finance, a 10-year strategy for Jersey to become a leader in sustainable finance as an IFC. But a lot of my work is also with governments and the finance sector on shaping the future of the finance industry from a reporting and disclosure perspective. And so I'm currently working on a twin for the TCFD, which is the Task Force on Climate-Related Financial Disclosure. And its twin is the TNFD, which is the Task Force on Nature-Related Financial Disclosure, which about 74 financial institutions, governments, regulators are all working on that. We're going to launch the work plan later this year. And by 2023, we'll have that framework done. So sorry, guys, another headache on reporting coming your way. But what I have done, I've spent 40 years of my life traveling around the world and working at the front line of conservation issues as well. And I have the benefit of seeing these changes that are happening to our planet. And I just want to step back from what everyone's been saying a bit and ask, why is this happening? Why are we all talking about ESG? And it's really happened really fast, because if you go back 2 or 3 years, the ESG department were the people down the end of the passageway with no money that nobody really wanted to talk to. And now the fastest, certainly in Europe, the fastest recruitment is in new ESG teams to guide the future of investing. It's an extraordinary change that's happened in less than 2 years. And watching this over 40 years, it's a change I've long expected to happen. But why is it happening now? And I think there are a number of things. First of all, the Paris Agreement in 2015 proved that governments could actually agree on something about climate. Then the TCFD created a reporting and disclosure framework, which was then mandated by governments. So you're getting the UK, France, other governments now making it mandatory to report on your climate risk in your portfolios. That's fundamentally changing the cost of capital and will eventually change the movement of money. And we've also had more and more reports coming out saying we're in a mess, not only about climate, but our oceans are full of plastic. The 2 biggest sources of plastic in the ocean are, rather surprisingly, car tires and clothing, microfibers. And we've no idea what effect this is going to have, but it's a huge amount. And we're seeing the basic collapse of nature around the world. And the World Economic Forum said that about 44 trillion of our global economy was dependent on services from nature. That's half global GDP. So this has got through to ordinary people in the street in a new way. And most of our money is their money. It's pension fund money from people. And there's a big movement starting up in Europe around the concept of make your money matter. People are asking questions of their pension funds and saying, I don't want my pension fund to be stuffing up our atmosphere or destroying life on Earth. And can you prove to me that it isn't? Well, today, of course, no fund manager can. We lack, just as others have said earlier, we lack definitions, we lack standards, we lack data and metrics. But the movement is coming and there's no going back. ESG stocks are no longer a sort of, well, I've got to sacrifice returns if I go into ESG stocks. That's why the law is changing on the amount of money you can put into them. They're going to make money in the future. In fact, they've been doing incredibly well recently. There might be a bit of a bubble at the beginning, just like there is often when new things come around. But this is part of a big systemic change that's happening. And central banks can see it. And they're beginning to move as well, refashioning the systemic risk in our society. I mean, it's extraordinary. 2 things I'll just end with. 2 things were extraordinary in the last 12 months. First, last year, the Dutch central bank carried out a complete assessment on the extent of nature-related risk in the entire Dutch economy. And they produced that report with one of my think tank in Oxford that I also started some years ago, a tool called Encore. It's now being used by the French central bank. Singapore is looking at it. They're all looking at these sorts of risks. That's extraordinary for central banks to do that. Second really extraordinary thing, BlackRock last month announcing that you have to start looking at deforestation, biodiversity risk, and ocean pollution in your portfolios. They're going to start voting you down if you don't have a policy or not doing anything on that. So these are really big changes that are happening, and it's only going to accelerate, and it cannot be ignored. And we just have to get used to it. And so that's where I think it's super exciting for the next decade of investment as to how these changes are going to happen.
Yeah, just before we get specifically into the US, which is where we're going now, I just wanted to partly endorse what you've just said, because I've got I've got a son who's just left university, and I've got a daughter who's at university. And when you hear them talking and about their future, they're going to be on this planet probably an awful lot longer than certainly me and some of the others perhaps on this on this Zoom call today. It's a very different mindset of that generation. You're hearing their friends discuss things. It's in a way we didn't of my generation when I was at university or just leaving university. And they do take the world perhaps a lot more seriously than, and they do, as Andrew says, they want their future investing assets put to work, and they're slightly less interested perhaps in the final degree of return in some situations than perhaps we would have been at the same time. So I just mentioned that in passing. So let's get into the US, because that is the huge seismic, for us who live outside the US, this is, and indeed if you live in the US too, this is the huge seismic change, recent change in ESG investing, is we now have this new administration in Washington, DC, as Bob says, and he may well be right, trying to do a lot of things in a hurry before the midterms come along, perhaps. Debbie, as somewhat of close observer of the scene, close observer of the SEC, and close observer of all things in Washington, from your perspective in New York, what does this mean?
Yeah, so I mean, I think, there's obviously a lot of changes in the administration, some of which we talked about already. And I think, I'll focus on kind of what's been happening at the SEC. I think they've moved, very quickly in the past few months with a number of kind of formalizing initiatives and things like that. And so I'll talk about a few of those and then kind of what that might mean, what it might look like as far as guidance coming from the SEC in the next couple months. And what are things, kind of fund managers can maybe think about, particularly those who are registered with the SEC. So just as far as some of the things that the SEC has done already, every year the SEC comes out with their exam priorities. In 2020, ESG was mentioned, but I would say kind of in maybe a less specific way than they mentioned it in 2021. In 2021, they specifically said that they were going to be reviewing the consistency and adequacy of disclosures of registered investment advisors that they're providing to their clients regarding these types of strategies. They're particularly going to be looking at whether or not these firms' processes and practices are matching the disclosure they've given to investor, whether that's in their offering documents, their Form ADV, or any kind of marketing materials. They're going to be reviewing all of that disclosure for any false or misleading statements. And then they're also going to be looking at advisors' proxy voting policies and procedures. And so, for example, if you're a fund manager and you say that you're considering ESG factors, and then you haven't really demonstrated in your proxy voting process how you have done that, then they're going to ask, kind of whether or not there really is that alignment that you've, kind of promised to your investors. So that's one of the, kind of the first things that they've done. There's also, a newly appointed senior policy advisor for climate and ESG at the SEC. And this is kind of across the board. And in this new role, that person's really going to be advising the SEC on ESG matters and advancing new initiatives across its office and divisions. There's also a new enforcement task force that's focused on climate and ESG. There's 22 members, and it's led by the kind of acting deputy director of enforcement. So I think they're showing kind of a strong tone at the top of kind of importance of these types of issues. And really what the task force has said that it's initially going to be focusing on any material gaps or misstatements in issuers' disclosure. So there we're talking about really public companies who are also under the jurisdiction of the SEC. In particular in relation to the climate risks that need to be disclosed under existing rules. They've asked for comment about whether or not those rules and that type of disclosure should change as well. That's probably one of the newest things that they've done in relation to the public companies. So that'll be interesting to see where we end up in that. If if the public companies disclosure does become a little bit more standardized, I think it will become a little bit easier also for fund managers who are trying to compare, kind of the ESG status or scoring of these different companies, where right now there really is no standard disclosure. And they also said that the task force is going to be analyzing disclosure and compliance issues relating to investment advisors and funds ESG strategies. So that's another thing that, that they've mentioned. There also is a subcommittee under the asset management advisory committee that's also studying diversity issues. They've indicated in some public hearings that there also may be a change in the disclosure for registered advisors in connection with Form ADV. So obviously, Simon, you mentioned, earlier kind of the work that you have done with your group as far as looking at diversity on the ADV. I think now they may, potentially change the questions and ask for people to disclose the race and gender of directors and officers in connection with the investment manager. So it'll be interesting to see if that, change happens to the form.
That's fascinating. Yeah.
Yeah. And so I think, so it is showing that I think they are looking kind of beyond climate. I think at least for the public companies, they're starting with climate because that's where they have some existing rules. But I think, they're going to be broadening that out probably to diversity and inclusion as well. They also have kind of devoted a whole web page, which is kind of, you can link to right directly from the first kind of opening page of their website that's devoted to climate and ESG risks and opportunities, so that all of the information really is in one place. One of the other things that they did do last year is they did, kind of a sweep of asset managers. So what happens is that sometimes the SEC will do a particular sweep in relation to a prominent issue, and they'll look at just that issue for a number of large asset managers. And in this, sweep exam, they asked for a number of, kind of very detailed information. They asked for managers to give their ESG policies. They asked for, very detailed information if you said that you used any kind of scoring system, whether that was one that you developed in a proprietary manner or one that you were using by somebody else, and kind of what due diligence then you did on that third-party service provider. They asked for documentation in connection with your proxy voting decision, whether or not you've submitted any shareholder proposals or otherwise engaged, with corporations and issuers. And so there's obviously, kind of a number of very detailed questions. What we would expect, kind of in the ordinary course following those sweep exams, the SEC usually will provide some kind of guidance, whether that's in the form of a risk alert or kind of an IM guidance, where they'll kind of go through some of the most common deficiencies that they found during that sweep exam. And then, usually the expectation is from the industry that then you will have read these types of guidance and that you will kind of implement and adopt your policies and procedures accordingly. So I think that, there are a few different ways that the SEC can come out with this. I think, one, I think there might be this initial focus on kind of public companies, their disclosure on these issues, maybe starting on the climate front, but then I think eventually, moving also more towards diversity and inclusion, whether that's for them also disclosing, the diversity of their board composition as well. And then I think, the SEC's processes, I think they may come out with, kind of some kind of risk alert or IM guidance, which would be in some ways maybe more of an informal way of kind of letting the industry know their thoughts and focus on ESG. The other way that they can go, and if they were going to make changes to the Form ADV regarding diversity, is they would come out with rules. The process for that is that it usually takes a little bit longer. They would come out with proposed rules. There would be a comment period, and then there would be final rules. And then something would go into effect, kind of shortly thereafter those final rules are published. I do think that that is probably likely, but obviously, again, that time frame might be a little bit longer than some of this other guidance that we might see. Historically, the SEC has usually taken a more principles-based approach to the regulatory regime, as opposed to, I would say, maybe a little bit more of the prescriptive approach that we've seen with the EU and SFDR. So I would presume that that would continue. I think, kind of as Bob mentioned earlier, there are a lot of different ways to address ESG. One thing we work with our clients on when they're developing their policies is that it can't just be one standard, one size fits all policy. The way that you think about ESG, whether it's in your investment process or in your firm, is really going to vary depending upon what kind of fund you are, what kind of strategy you have, also the culture of your firm and how you just think about your investing process, how you normally engage with management, how you think about voting proxies, how you think about shareholder engagement. And so really it's something that needs to be very bespoke and very specific. And so, it's definitely something that, we've worked with a lot of managers on. I think, from the SEC's perspective, I don't think they're going to necessarily come out with kind of definitions or, very specific rules, but I think they're going to really focus on the disclosure that people have given to their investors and whether or not you really then have the policies and practices to really back that up. And then kind of what kind of testing and stuff the managers are doing on the back end, which is, similar to what we've seen with other, compliance policies and procedures. And then I guess just the last thing that I'll add is that, the new SEC chair, Gary Gensler, I think is likely to be confirmed later this month. There was a huge focus on ESG during his confirmation hearings where he was specifically asked about whether or not he supported increased climate disclosure. that indicated that he did. I will say he was previously with the CFTC, which is another regulator in the US, and he was more of an activist, chairman. As opposed to, maybe some other predecessors of his. And so I think we can, again, maybe expect him to be similar, within the SEC. I think the, kind of the current acting chair, Allison Heron-Lee, has been very, kind of active in connection with her support, whether it's been climate disclosure or human capital. She's very focused on also shareholders' rights and shareholders' proposals. So I think we may see, some changes in that too, in order to make it maybe a little bit easier for people to submit shareholder proposals, particularly in connection with things, whether it's related to diversity or governance matters or climate. So I think those are some of the things that we might expect to see from them in the next couple months.
Thank you. Somebody's asked a question. If you can do this very briefly, because we've got so much to go through and the time is more marching ahead. What would happen, someone basically has asked, if there was a change in administration, whether it's Donald Trump, Ron DeSantis, whoever it may be, a Republican administration that is not so supportive of the ESG movement and some of the things that are happening, say in 3.5 years' time, would that be too late to do anything about it? If you can give a very brief answer to that, it's quite a good question actually, because we all assume this is forever, but maybe it's not. Who knows?
Yeah, no, I think that's a really good question. I will say, I think on some of the broader things, so as far as, whether or not then, some of those climate initiatives and kind of carbon neutrality and all of that would occur, by then those timeframes, obviously you're assuming you would have administrations that would continuously be supporting that in order to reach those goals. So that I think obviously, is going to be dependent upon what happens with the future. And there's no guarantee that any predecessors of Joe Biden would continue with that. I think that's probably more at risk than the fund management industry. I think, you really have the investors pushing for this, which we've talked about before, and B, usually the SEC, other than kind of the chair who's more of a political appointee, usually the SEC's kind of staff, and whether that's on the enforcement side or on kind of the division of examination side, they usually will be fairly consistent even during different administrations with how they're looking at things. So while you may not see an increase in rules, what usually would happen is once a rule goes into effect, it's not going to be it's not going to be negated by another future, kind of SEC commissioner. Once it's there, it's usually there to stay. And so I think if those rules are implemented in the next 4 years, or 3.5, whatever we have left, that really would be there to stay. And then, usually again, the SEC staff's focus on kind of disclosure and making sure that you're doing what you say you're doing, and those material misstatements and omissions, I think that's going to be, again, something that they're going to always continue to look for, regardless of kind of the overarching administration.
Thank you very much. I'm going to move on. I'm very conscious of time. That's great. Thank you, Debbie. Elliot, can I ask you, you referred to reporting in your introductory remarks. What do you think is the right way for, whether it's the US or Jersey or the UK, and the SFDR has already been mentioned, what is the right way to go about reporting ESG? What thoughts do you have?
Look, Sam, again, I'll come at this from a jurisdictional perspective. I think that the question is far wider than reporting or regulation. We've seen historically that asset classes congregate to jurisdictions, and I personally believe that there's an opportunity for a single jurisdiction to come to the fore in this ESG space. But I don't think that there is any single conduit, and that includes reporting and regulation. I think that ESG is far more than reporting and regulation. I think it is a mindset. From a Jersey perspective, Jersey's coming to the fore in the ESG space because of a combination of strategies. So you've got the work and the government, the work and the vision of our government, a series of consultations that the Jersey Financial Services Commission, our regulator, have carried out from a regulatory perspective. You've got the Jersey for Good project, commissioned by Jersey Finance and led by Andrew Mitchell, which is a 2-year plan to accelerate our journey to a sustainable future leading up to 2030. And I think all of these things will collectively shape our credibility in this space. But I also think it's more than that. I think there needs to be a trigger to start the conversation and for our funds industry to lead from the front. And we have in Jersey a scheme called Jersey for a Wilder World. The scheme is a joint project between industry, government, Jersey Overseas Aid, and the world-respected Doe Wildlife Conservation Trust. And it's aimed at sending a very clear message that Jersey and its service providers are committed to the ESG agenda and to supporting global investment aimed at driving positive change. In essence, the service providers will contribute a percentage of their fees for Doe to distribute across their rewilding programs around the globe, and they will receive a kite mark for doing so. But it will also allow them to demonstrate their credentials in the growing ESG market and start the conversation. And it's because of all of these things, the uniform and joined up approach of our entire funds industry, government, regulator, and industry, based on our base of stability, that I think will lead Jersey to lead the way in ESG from a jurisdictional perspective.
Thank you very much. Well, you mentioned, Andrew, this is the right time to bring you in and talk about, as you mentioned in your opening comments, Andrew, the task force for nature disclosure, and you made the points about nature. Why hasn't there been, when you were making those comments earlier, I was wondering, why hasn't there been more on that in the whole ESG movement up until now? Everyone's focused very much on the green stuff. The social stuff has come up on the rails quite recently, especially since the pandemic happened. But until you made the comments you made earlier and briefly in our prep call, there really hasn't been that much on nature per se. A, why is that? B, what is being done about that? And will this task force on nature disclosure really be able to make much of a difference? Or how can a difference be? Should there be more funds focused on nature than there are? I just don't know anything about where we've been on that.
Yeah, well, the E of ESG really is only a C. Because it deals with climate. And nearly all of the what you call the E of ESG, if you actually look at what people are doing, it's all around climate. And the penniage sort of dropped on climate from 2015 onwards. And now everyone takes it seriously, and people who are still funding coal are, have lost a lot of money, and they're making money in some areas, losing it in others. And big firms are beginning to change their investment policies. I mean, even JPM, which is the biggest funder of fossil fuels on the planet, reduced its investments in fossil fuels by 20% last year, but it's still 51 billion, it's a hell of a lot of money. And you kind of can't have it both ways. I'm not sure, I kind of feel Jamie Dimon's trying to have it both ways, but when you're a really big bank like that, then of course you're into everything, but the pressure is on for that sort of change to happen, but it's mainly about climate. The nature stuff has really only got going in terms of realizing that the dependency of our economy on services from nature, which is huge. And that means, cotton, coming from agriculture, our entire food system. We're worried about plastics getting into the ocean. There's been a lot of worries about that. In the same way we're stuffing up the atmosphere, we're stuffing up our natural world as well. But that didn't really catch on until a couple of years ago. And particularly it's accelerated since the beginning of 2020 due to a small speck of nature, which has turned all our lives upside down, and the world economy called COVID-19, or at least that's the disease. And that little virus has been driven by environmental degradation, the illegal trade in wildlife into China and southern Vietnam. The evidence seems to be mounting that and this has happened many times before. Through other coronaviruses, and it probably will happen again, but it's never happened at this scale. And when you consider that approximately $12.5 trillion has had to be deployed by governments to prop up economies, that's what we mean by nature-related risk that nobody recognized. Everybody thought it's just about agriculture. It's a long way away. Nature's gradually destroying, but it's not going to happen, not going to affect us anytime soon. And it's not very big. And all of that has been turned on its head in the last year. So now people are scrambling to say, this stuff is really big. And actually, it's thrown something at us faster than climate, bigger than climate and hitting all sectors. We never thought that was possible. So people are starting to take it very seriously. So the TNFD, the Task Force on Nature-related Financial Disclosure, is an attempt by the financial industry and regulators and some governments to come together and say, well, how do we deal with this? Can we create an overarching reporting framework that will make our economic system safer by forcing the financial sector to report and eventually disclose its nature-related risk in the same way that it's beginning to do with its climate risk? The problem with nature is we don't have any numbers. We don't have a target like 2 degrees. We don't have a currency like a ton of carbon. So all of this has to be worked out. So this task force is assembling a sort of 30 members of the financial sector, rather like the TCFD did, technical advice groups, working groups, and so on, to grapple with these issues. So we've got to look at the data, the standards, the metrics that will be necessary for this kind of reporting to take place, and which kinds of sectors are going to be most affected and are most dependent on nature and have the most impact on nature. They're not the same thing. You know, a drinks company might depend on fresh water, but a mining company might be stuffing it up. So there's 2 different perspectives there. So that's what the task force is going to look at. By 2023, we'll have the framework done and out there. It'll be voluntary at first, I expect. But I think that my hope is that fundamentally, it will change the movement of money to be much more sensitive to its impacts on nature, in the same way we're becoming much clearer about our investments and their impact on climate. And I think it will become mandatory over time. That's
presumably just for the UK, but hopefully adopted by other countries around the world, potentially the US and other. Are the people you're talking to in other parts of the world as well?
Oh, well, this is not a UK initiative. This is a global initiative.
Good,
so
good.
The representatives are worldwide. We have the US, Europeans, Asians, the monetary
authority.
So
this could be adopted by the investment industry in multi-jurisdictions, is what you're saying.
Definitely, you know, but America this is what, as you said earlier, it's kind of strange because America is waking up slowly to this. It's woken up slowly to climate. And actually one of the benefits of Trump being so anti-climate is that one way to get back at Trump was to be pro-climate. So the finance industry really gripped this, and it's really interesting to see. And I think you're right in saying that the investors are really behind these sorts of changes, whatever administration is there. And I think Biden will accelerate it. Trump would just slow it down, but it's not going to change. It will keep moving in this direction. And a really interesting thing to come out just last week to show how this is globalizing is the report on China is now looking to form at least a dialogue with Europe on its ESG policy, because they see Europe as coming out in front, and China has done a lot on green finance, is tackling its own pollution, its very difficult emissions problems, and all these other things. And China is looking for guidance on this. So the fact that these 2 huge economies are really beginning to look at this seriously, it wouldn't make sense for America to be left out in the cold.
All right. Good. Bob, can I come to you? You might need a notepad, because I'm going to throw 2 or 3 different questions. I'm very conscious, sadly, of time. We should do these things over longer. So I'm going to give you 2 or 3 different questions at the same time, if I may. One of them is something we plan to talk about anyway, which is, should the E, the S, and the G continue to be grouped together? Something you and I have talked about in the past, which is, where does the G fit into all of this? And finally, someone's asked a very good question to the panel, is whether or not, given the lack of progress that there has been at least in the international asset management industry, I think it's much better in the US, but it's pretty appalling outside the US in terms of board diversity. Insofar as you can measure it, it's pretty appalling. I gave 1 or 2 figures in my introductory comments. Do you think there should be something mandated, as it looks like that's the way the US is going? Do you think that something should be mandated in terms of diversity, in however you want to define it, or should it just be all voluntary? So 2 or 3 very different questions, not very different, but somewhat related and unrelated. Over to you.
Sure. Well, look, I think, as I said in my opening remarks, I think the E, the S, and the G should very much be seen as separate items. I mean, if you look at pretty much, I think, as Andrew already pointed out, the E has pretty much been climate change. And until the Dasgupta report came out in the UK, recently biodiversity hadn't even entered The Guardian, for example, which is the bastion of ESG when it comes to the media. So, I think there is a huge amount of stuff that sits beneath those acronyms, and then people like kind of acronyms of three for some reason. If you look at, say, a central bank will often seize on climate change as being an indicator of financial stability, but they will not look at an S, because the reality is when you look at something like QE has been argued by many people to contribute to inequality because of the impact it has on asset prices. And then, of course, the G, to your point, I think, as we've discussed in the past, often becomes the poor cousin at the end, where they kind of go a bit silent. And I think the conversation is going to be moving on in all of these areas gradually, bit by bit. And I think the G will gradually move up in importance, primarily because one of the important things is that there is a great love at the moment of regulation to drive this forward. And I can understand why, but ultimately it has to be a cultural change. And a cultural change can only be policed internally. Otherwise, all you do is you create arbitrages, because it is almost impossible to get a consistent playing field across the world. So the G will become extremely important, not in its own right, but as an enabler of actually managing these risks. And I would always see it in the perspective that if you look at ESG really is more about looking at longer term existential risks to a business and thinking about how does a business survive not just the next quarter, the next year, which is ultimately down to performance and hopefully no operational screw-ups, but actually how does it survive for 5, 10, 15, 20 years? It's actually part of business strategy. And so when you think of it from that perspective, the governance piece actually becomes very, very critical. That's your first part. The second part is, so should there be quotas? It's an interesting question. I mean, I come from India. In India, they introduced quotas for a number of jobs, a number of universities, etc., across the board from 1947 onwards. And it got to the point where if you take the top universities in India, they have so many quotas in there now that to get into the top universities in India, if you are not part of the various subgroups that are allocated a place already, you need to score on typically somewhere between 98.5 and 99.5% in your exams across the board to get in. And that has a huge impact, because for a lot of people, it actually creates enormous tensions. It creates a lot of social tensions, by the way, because there is a huge backlash against what is perceived as an unfair quota system. And it ultimately has led to a large part, arguably, the rise of the far right, or the right at least in India, in terms of the BJP. So quotas in principle, while they can serve some purpose in driving change, much as I said, ultimately has become a cultural shift. And we have to also remember, why do we talk so much about diversity and inclusion? We're not doing it just because we ultimately want to have lots of different people on boards, and it has to somehow tick box lots of things. That's terrible. I mean, that's no difference to South Park with Token, as it were. What it actually is meant to be is it's meant to be a way of getting ultimately to diversity of thought and diversity of perspectives. Again, if you think about it from the perspective of a business and what you care about, guess what? If you go for a classic, the traditional board, which was, let's face it, pale, male, and stale, as it were, that was always going to be a board that came with a bunch of groupthink attached to it. So if you want to break out of groupthink, diversity is critical. I think quotas can help a little bit, but they should never be seen as an answer, because I think if you do that, there's a real danger that you devalue the contribution that other people will make. I mean, I can tell you that is a very simple example. I fit a very classic BAME label in the UK, right? And I mean, I have to admit that, I mean, most people I know in my, within quotes, BME category have a conflicted relationship with that, because, it kind of feels like you're being labeled, and it's terrible. Why should you be labeled? And on top of that, if you then get into something because you happen to be BME, you can have that inevitable question as to, was it my ability? Was it something else? And other people may have that same question beneath the surface. And it's those unwritten, unsaid prejudices, that unconscious bias that eventually comes out, that is far more damaging to a culture. So that's probably where I stand on those aspects.
Well, thank you. I am. We've rattled through this. I said this to you in the prep call that we never seem to have enough time. It goes by far too quickly. I realize we're up at the end of the hour right now. I do feel, particularly today, we're just scratching the surface in all these topics we've been covered. We should probably go into one of each of them and have a good hour on every single one of them and go into an awful lot more detail. But thank you all very much indeed for joining us today. As I mentioned in my opening comments, we will be delighted to send you the domiciliation research results, which do include a section on ESG, as I mentioned earlier. We'd be delighted to send you a copy of our ESG publication, which is called the Briefing Report. I'd particularly like to thank Jersey Finance for their support of this e-event today. And we hope to be back in New York in person, maybe to discuss these subjects in more detail a little bit later on in the year. But wherever you may be, whether you're in the US or elsewhere, have a good afternoon, evening, and hopefully see you the next time. Bye-bye, everybody.
Pleasure to be here. Thanks, everyone.
Thank you.